when you want to align time frame where in any asset class, whether it's Forex, crypto, or stocks, commodities, anyone at all, the first thing is usually to start from the highest time frame, which is the 12-month time frame, because you basically want to know what is the market structure on that 12-month time frame. And the moment you can see that in this case, the market structure was trending to the upside, creating higher highs and higher lows and a higher high, and then eventually dropped to the downside and broke the previous low here. So the moment this low gets broken, now we're bearish, and our focus will be on looking for sells. Now, there are a few ways you can go about aligning time frames. Now, I'll walk you through two different ways you can do it. Now, it's entirely up to you to choose which one you feel most comfortable with. Now, the first way is, now you can see a break of structure. You box your point of interest where you want to see price come into and sell. Now, you can notice that there's two fair value gaps here, one below and one above. And this one below right here, price mitigated it and still had this impulsive reaction, despite the fact that it wasn't the area that will facilitate a continuation to the downside. But can you see how impulsive or rejected and went to the downside? To tell you that there's a lot of bearish momentum here. And look at how price went to the downside. Every single candle here is 1 year. So basically six candles. So for 6 years, the market was going to the downside for 6 years. And after that, we now had this slight consolidation that took us to the upside into this fair value gap. Now, to align this time frame to derive where to enter, how to enter, and why you should enter, once you can see that this 12 months is bearish, what you can do is you can go to 6-month time frame for just confirmation to confirm this price action. And right here, you can see that this also confirms that it's bearish. There's no active break of structure to the upside. And what do I mean by that? What I mean by that is when price came to the downside, this is one leg to the downside, and then it created a high. And this high it created did not create a new low. If this high had created a new low, and then we rallied to break above this high, now that is the break of structure. Even though it's not a guarantee that us breaking this high means bullishness, but we stand a better chance of going higher because here is a high, has now become a high resistance liquidity. But in this case, there was no run on liquidity. So here becomes
The low resistance liquidity.
exactly, here becomes a low resistance liquidity. That means whatever sell we're looking for up here, we'll be targeting for it to drop to the downside to run out this area in the long term. Now we have that at the back of our mind. Structure is bearish. What we are now looking for is to align that bearish structure on the higher time frame to the lower time frame. That's what we want to do. We want to align the bearish structure that we can see on 12 months, on 6 months. We want to align it with the lower time frame and look for sells. How we do that is, number one, when we go to the monthly time frame is still showing us bullish momentum. There's no bearishness here on monthly. So the only thing we can use monthly to do is to mark points of interest, and that's it. Mark drawn liquidity, mark fair value gap. That's all we use the monthly for. Now, we go to the weekly. And on the weekly time frame, the weekly is still bullish. Now, I'll write this on my screen so it can be easy for you to recall what I'm saying. So 12 months is bearish. And 6 months, our confirmation time frame is bearish. These two time frames are the two time frames that will decide the direction of the market. Now, when we go to 1 month time frame, we can see that 1 month time frame is bullish. So all we're going to use the 1 month time frame to do is to look for fair value gaps that we can take as a point of interest for a buy or for a sell. Sorry, not buy. We can use the point of interest for a sell. We can use points of interest like low resistance liquidity as a draw on liquidity for price to go either to the upside or to the downside. An example of what I mean is you can see this low here, even though this is weekly, but if we go to monthly, you can see that these lows right here, what did we call this low here?
Low resistance liquidity, a draw on liquidity.
Exactly. It's a draw on liquidity, low resistance liquidity, the magnet. It will attract price to the downside. So now we've outlined this. All we're using the monthly and the weekly to do because they don't align with the 6 month and the 12 months. All we use them to do is to mark points of interest, draw on liquidity, take profits, point of interest to take trades. That's all we use them for. We don't do any higher high and higher low analysis here because doing that, the only thing it's going to do is to confuse you. This is the reason why most traders, when they go to weekly, they are bullish. Daily, they are bearish. Now they are confused. Today they buy it, tomorrow they sell it. So instead of doing all that, you focus on the overall direction that the market is showing you wants to go. You use the monthly only for points of interest, low resistance liquidity, fair value gaps. When you go to your weekly time frame, you can see that your weekly time frame is bullish as well, creating higher highs and higher lows. So all you do is you come here and you mark it as well. Weekly is bullish. So weekly bullish, monthly bullish. The next thing we do, we go to daily. And when we go to the daily time frame, we can now see that the daily time frame was previously trending to the upside, creating higher highs until we dropped down here and broke structure. Now that we can see that the daily aligns with the 12 months, our focus is now going to be on how do we use the daily time frame to continue selling. I don't know if that makes sense.
Yeah, so basically, we're not expecting every single time frame to be in alignment with the yearly or and the 6 month. Just start trading the three to the left.
Yeah. So if we are waiting for all the time frames to align with the 12 months, we'll literally be too late into the trade.
Okay.
So I'll show you what I mean. For example, if we say let's wait until monthly aligns, that
Hmm.
we're going to wait until this monthly low here gets taken before we start trading USD card. And look at how long that's going to take. That's going to take 1, 2, 3, 4, 5, 6. 6 months doing
Yeah,
nothing.
you'll never trade.
That's the thing. So it will be too long for us to wait. So instead of us waiting that long, what we do is we use the time frame alignment to derive which of these time frames aligns with the 12 months. That's all we're looking for.
Okay.
Which of the time frames? Is it daily? Is it 4 hour? Is it weekly? Any one of them that aligns with that 12 months, we go straight to that time frame and use that time frame structure to look for trades. Now, once we can see that daily aligns with the 12 months, we now focus on the swing highs and the swing lows on the daily and trade in between those swing highs and the swing lows. So example, this is the swing high, this is the swing low, and this is the new swing high, created a new swing low. So whatever price is doing right here, we are anticipating for it to create another swing high, whatever that is going to be, and create a new swing low. So once we see it creating a new swing high, mitigating whether it's a fair value gap or running liquidity from a low resistance liquidity, once we see it break structure to the downside on 1 hour time frame, we'll focus again on looking for sells to continue lower. So I know it might seem a little bit complicated, but we'll go through several examples so it's much easy for you to understand.